Good afternoon, everyone. Over the last 20 years, big institutions, sovereign wealth funds, and mega-rich family offices have invested trillions of dollars into global private equity. Unfortunately, for Australian retail investors, this opportunity has never been available. Fortunately, for the very first time, early next year, through the Pengana Global Private Equity Listed Investment Trust, Australian retail investors will, for the very first time, have the opportunity to invest into a listed vehicle that gives them exposure to this incredible asset class. This is truly a game changer for your portfolios. So what am I going to do today? I'm going to give you a brief overview of who is Pengana Capital, talk about global PE, what is it, talk about why global private equity is in such great demand, then go through the reasons why Australian retail investors to date do not have any of this exposure. I'll also talk about our investment management partners in this, which is Grosvenor Capital. And then I'll give you an overview of what the trust looks like. And finally, if we have some time, I will end with a case study. So let's get into this. Pengana Capital Group. Pengana is a listed, publicly listed funds management group. We specialize in providing products to our investors which really help them in their overall portfolios. They diversify their portfolios. They generate long-term good returns with lower levels of risk. And you find across the Pengana Group, this is what all our products have achieved over many years. We go out into the world and we find best-of-breed solutions for our clients. So when we identify a space that we think our clients should be invested in, we go out and we find a team to join Pengana that can manage in that strategy. In this instance, as I mentioned, in global private equity, we have joined up with Grosvenor Capital, who are one of the world leaders in private equity investing. We've been going for over 15 years now, and we manage about $3.5 billion across our business. So what is private equity? So private equity is an investment that is made into a private company, so into a company that's not listed, and this is done together or through a private equity fund manager. Now, these private equity fund managers are experts in investing in private companies. They're very hands-on, so they don't just invest and passively sit on the sidelines waiting for things to happen. They invest and they get actively involved in the companies, in their strategies, and sitting on their boards. And they genuinely provide a lot of value-added services to the companies. There are three ways of investing into private equity through these private equity fund managers. The first one is called a primary investment. So a primary investment is one whereby the private equity fund manager is raising a new fund, and they call up investors and say, would you like to invest in that fund? These funds are usually very long-term, so they take 10 or 15 years until all the money is sent back to investors. And that's called, as I say, that's called a primary fund. A second way of investing is through something called a secondary. And what happens in a secondary is investors who've invested in the primary, for whatever reason over that 10 or 15-year period, might decide to sell out of their investments. They need some liquidity. And if you're an investor who understands the secondary market, you can actually go out and you can buy these pieces of private equities. It's like second-hand private equity. And the third way of investing in private equity is through something called co-investments. And co-investments are when a private equity fund manager has an investment, but that investment is too large for them to fully utilize in their portfolios. So there's excess amounts that's required, and they'll call up their best investors and say, hey, do you want to invest alongside us in this opportunity? So that's, and then the private equity investor will invest directly into those opportunities. So those are the three ways of investing into private equity. Some things that private equity is not. So it's not venture capital. So we all understand venture capital is when you go out and you're looking for startup businesses that are not making any money, that might be worth hundreds of millions of dollars one day, and you take a punt. This is not that. This is investing in good medium-sized companies. They probably average $1 or $2 billion a piece, but they're unlisted. They've all got good cash flows, and they've all got good growth prospects. So why is this such a game changer for Australian investors? Well, the statistic I've got up on the page in this big circle is an absolutely fascinating statistic. I actually found it quite mind-blowing when I heard it the first time. And that is that if you take all the companies in America and in Europe with revenues of in excess of $10 million, only 2% of those companies are listed. So if you're an investor solely in listed companies, you are missing out on 98% of the opportunities available in the world. Incredible, 98%. In addition, equity markets in the US and in Europe are actually shrinking. So in the year 2000, there were about 9,000 publicly listed companies in the US. Today, there's almost 4,500, just 50% of what there were 18 years ago. And the reason for this is that it's very difficult in this day and age to be a publicly listed company. The regulations are very strenuous, and it costs a lot of money to comply with the regulations, and the regulator or the governments do not make it easy. So a lot of companies have moved from being public to private, and a lot of companies who many years ago would have listed their businesses aren't listing anymore. And that's why there's such a big amount of private companies. These companies, whilst they're private, they still do have capital requirements, just like public companies have capital requirements. And so the private equity fund managers have moved in to fill this void and to supply this capital. So there's a vast amount of private equity opportunities for managers to take a look at. The other thing to note is that in private markets or in unlisted markets, there's far less competition. There's far less research, far less transparency about what these companies are worth. So when the private equity fund manager goes out and bids to buy a company, by and large, they find it relatively easy to get good deals, whereas in the public market, it's very hard to find good investment opportunities. So this is the result. You can see in the US, Europe, and Asia, over both a 10-year time period as well as a 20-year time period, that private equity has vastly outperformed public equities. And it's this type of performance that we're seeking to try and generate in our portfolios. This page shows you the index for private equity. So this is all private equity firms relative to the S&P or the MSCI indexes. And you can see that vast outperformance. Really, private equity is trying to ultimately double investors' returns every 5 to 7 years, whereas in the public markets, you're probably lucky to do that within an 8 to 10-year period. Private equity doesn't just provide a higher prospective return. Private equity also historically has had lower volatility. So it bounces around. The valuations bounce around much less than public equities do. So if you add something to your portfolio which has increased returns, lower levels of risk or volatility, and has lower levels of correlation with public equities, you find that it very much improves your portfolio. It makes your portfolios more robust or diversified. And you can see this gives you an example. It's a theoretical example, but really it's backed up by the historical returns, that if you add private equity to a portfolio of 60% equities, 40% bonds, and you take 20% of that and you put it in private equity, you can significantly improve the returns of the whole portfolio without increasing the risk of the portfolio. So this slide depicts the vast increase in interest in private equity. Those big institutions and mega-rich family offices that I spoke about before, they have been increasing their investment at a rapid rate into private equity. You can see from the year 2000, it's gone up about 500%, so just under $600 billion to $3 trillion today. So a very, very large increase. And at the bottom of the page is based upon a survey that shows that over 50% of investors that were interviewed suggested that they will continue to increase their exposures to private equity going forward. So what's happened in Australia? The big institutions, the big family offices in Australia have indeed invested vast amounts of money into private equity. You can see the Future Fund, which is a very sophisticated investor, recently came out and announced that they have 14% of their portfolio investing in private equity. You can see, because of the returns, because of the risk characteristics, why that makes such sense. As I mentioned before, unfortunately for retail investors and smaller, even smaller superannuation investors, there's very little of this available, only about 2% on average. So why is this the case? Why haven't Australian retail investors invested into global private equity? Well, the first problem is access. There are a lack of suitable investment vehicles. So most retail investors want to invest in a vehicle where they get good returns, but also have the flexibility of taking their money out as and when they want to. In private equity, I mentioned that the lock-ins could be 10 or 15 years. There are some vehicles which give more frequent liquidity, but in terms of a vehicle which can give you daily liquidity to allow you to trade in and out if you need to get capital, those haven't been available to date. In addition, the demand for private equity far exceeds the supply. So the good private equity fund managers, when they're seeking to raise a new fund, they get inundated with capital. They usually open their capital raisings in the morning, and by the afternoon, they're closed. Unless you are an investor who has invested in their previous funds, you do not get a call. Even if you did get the call, the minimum investments are huge. It's $5 or $10 million a fund. So a retail investor, obviously, this is beyond most retail investors' reach. And then you also have a very complicated drawdown structure where private equity funds say, give us your investment, give us your indication of investment, but we will only draw it down over a period of 3, 4, 5 years. And that can be very tough on a retail investor who doesn't want to have capital waiting by to allocate. In addition, the return profile of private equity is not particularly appropriate for retail investors. So what happens, it's a 10, 15-year investment, but over the first couple of years, there's no cash flows going to investors. And if you look at the changes in the value of the portfolio, it doesn't change much over the first few years. So it's a difficult thing for retail investors to get their heads around. And then finally, the expertise. How would a retail investor know where a good private equity manager exists, and how would they be able to evaluate private equity deals? That's obviously beyond most people's reach. So for all those reasons, global private equity hasn't been invested in by retail investors. As I mentioned previously, we have partnered up with Grosvenor Capital to provide, to manage the product. Grosvenor Capital are one of the leaders in the world in private equity investing. They've got almost $24 billion invested in private markets. They've been doing this for a couple of decades. It's really important that you're with one of the best players in the world when you're investing with global private equity. And the reason for that being is that if you are going to get the call from the best private equity funds when they're raising their new funds, if you're going to get that call, you need to be somebody who has a relationship with these managers. Grosvenor Capital has been doing this, as I said, for a couple of decades. They've invested in over 700 underlying funds. And so they get the call when the good private equity managers are raising money. When we talk about the good private equity managers or the superior managers, we're not talking about the mega managers who might raise $20 or $30 billion. We're talking about managers who might raise $500 million or $1 or $2 billion. That's the sweet spot. That's where the best performance is at. And Grosvenor have a market-leading position at that end of the market. And that was one of the key reasons why we chose to partner with them. When you look at global private equity, it's very important to look at the performance of the various quartiles. So what this means is that if you look at the top quartile, the top 25% of global private equity funds versus the bottom quartile, the bottom 25%, there's a huge spread. The difference can be 15 to 20% per annum in returns. So you never want to invest in global private equity if you're going to be in the bottom quartile. But if you can find the top quartile managers, it's a fantastic investment. So Grosvenor's whole business is established around this fact, finding those top quartile managers. And you can see what they do here is they look at a lot of funds. I think the technical term is you have to kiss a lot of frogs. So Grosvenor kisses a lot of frogs. They've looked at nearly 9,000 funds over the last 18 years and invested in about 8% of those. Likewise, they've looked at 3,500 co-investment deals and invested in about 7% of those. So their business is set up to evaluate managers, to find managers, to maintain their relationships with managers. And the result of that is that they've got fantastic long-term performance. This shows you their 10 and 15-year performance relative to other private equity managers and relative to the public markets. And you see there's a vast amount of outperformance. And it's this type of outperformance that we're seeking to deliver to you as investors in the trust. So let's discuss a little bit about what is this trust. So firstly, it's a trust that will be listed on the ASX. The advantages, obviously, of being listed on the ASX is that investors, whilst the underlying portfolios are very liquid, they're 10 or 15-year investments, you as an investor will be able to trade in and out of this and get your liquidity by selling your units on the market. This is no different to something like a listed property trust, where the underlying investment being property is very illiquid, but you as an investor can get in and out by selling on a daily basis. So it's exactly that same concept, not particularly novel. The portfolio will consist of about 500 underlying companies. So we're not trying to select a few of the best opportunities in the world. We're not trying to pick who are going to be the small group of the best fund managers in the world. We're trying to give you a broad spread across that top quartile of managers and of deals. And so if you look through the whole portfolio, there'll be about 500 underlying investments. In terms of return profile, I mentioned that if you look at private equity in the first couple of years, it's a difficult asset class. It doesn't show much return. There's no distributions to investors. We will structure this portfolio so that we target very good returns in the first couple of years and over the long term up to those top quartile returns. In addition, there will be a yield that will be targeted out of the portfolio as well. So not only are you going to be getting a strong growth portfolio, but you'll also be able to get some good yield. And finally, we'll be utilizing the expertise of Grosvenor to make sure that this portfolio is managed in the best possible way. Before I end, I just want to touch on an example of private equity. So a lot of people, listen to this, but they go, "But tell me exactly. Give me an example so I can get my head around this." So a great example is a investment that Grosvenor did a couple of years ago. So this investment was into a group called Staples. I think most people probably know Staples. Staples is in the US what Officeworks is in Australia. Massive business. They've got about 2,000 stores spread across the US. Staples was a listed company, and they were suffering from something called the Amazon effect. I think most of you have read about this Amazon effect, and that's when Amazon comes into a marketplace, the public markets just start selling all the competitors in that space, because the thought is that everybody is going to be suffering. Amazon's going to take the market from them. So in the office workspace, it was announced by Amazon that they were entering this space, and therefore Staples, their market value really suffered. Grosvenor, together with a private equity manager by the name of Sycamore, which is one of the top retail-focused private equity managers, went onto the market and made a takeover bid and acquired the whole of the Staples business. They bought it very cheaply. Once they had it private, they could do things to it that couldn't be done in a public market context. So a lot of those stores needed to be shut down. They were unprofitable. If you did this in a public market context, you'd be forced to write off massive amounts. In addition, there'd be a lot of scrutiny, a lot of press coverage. If you do this in a private context, you're likely to do it in a much better way. Secondly, Sycamore were able to sell off some surplus assets that were not being valued properly in the marketplace. There was a business in Canada. There were properties. They quickly sold off these or disposed of these assets, and they regained about a third of the cost of actually buying the business came from these assets, which had almost no value in the marketplace. And finally, they could concentrate on the best part of the Staples business, which was actually a distribution business. And this was very, very valuable. This business is one whereby Staples employs people that goes out to companies and restocks their stationery cupboards. That business is a fantastic business, but it was getting overshadowed by the Amazon effect. So a combination of doing all these things in a private market context meant that they would be able to quickly turn around this company, and it's estimated that this will be a fantastic return for the private equity managers. So that's a typical example of how private equity works. Most examples aren't actually taking public companies private. Most of them are private companies that just get recapitalized or changed hands in a private context. But that's a good example to show why private equity fund managers have such a great advantage over and above listed fund managers. So next steps, if you're interested, please either go onto our website or speak to my colleagues out in the hallway who can get you signed up, and take your names and email addresses and make sure you get all the information, and when we do launch the offering that you'll get the prospectus, etc. Thank you all for listening to me today, and hopefully look forward to seeing many of you as investors in the Pengana Global Private Equity Listed Investment Trust early next year.